In the first quarter of 2026, energy stocks outperformed big tech by over 18%. Let me say that again. The sector everyone called boring just crushed the companies that defined the last decade. And if your portfolio is still overloaded with mega cap tech, because that's what always works, you are positioned for yesterday's market. This is not 2021. This is not free money. And this is definitely not a growth at any cost environment. We are in the middle of a full-blown stock market rotation. Tech is losing momentum, energy is gaining dominance, and the top 1% of investors have already adjusted. The question is, have you? 1. The problem and the opportunity show chart, sector performance, YTD, 2026. Let's zoom out. It's 2026. The Federal Reserve has stabilized interest rates around 4.5%. Not zero, not emergency levels. A normalized rate environment. That changes everything. At the same time, infrastructure demand is exploding. The US is modernizing power grids. AI data centers are consuming record electricity. Emerging markets are industrializing. Global supply chains are being rebuilt domestically. And here's the key shift. We've moved from speculative growth to real-world assets, physical assets, cash flow producing businesses, hard commodities. But the average investor, they're still chasing yesterday's winners. They're dollar cost averaging into broad tech ETFs. They're holding on to unprofitable growth stocks. They're hoping for another 2020-style liquidity boom. Meanwhile, the top 1% is reallocating. They're adjusting their asset allocation. They're increasing exposure to energy, commodities, and short-duration income. They're prioritizing portfolio diversification over hype. That gap between what retail investors are doing and what capital allocators are doing is where opportunity lives. And today, I'm going to break down the 4 pillars driving the 2026 stock market rotation. 2. The deep dive, 4 actionable pillars. Pillar 1, energy ETFs. Cash flow is king show chart. Energy sector ETF versus Nasdaq 100. Let's start with the obvious. Energy, oil, natural gas, LNG exports, pipeline operators. In a 4.5% interest rate world, companies must generate real earnings, not just revenue growth. Energy companies are printing cash flow. Balance sheets are cleaner than they've been in decades. Many firms are returning capital via dividends and buybacks. This matters for compounding interest. If you invest $1,000 into a diversified energy ETF, yielding 4% annually, and reinvest dividends, and the sector grows at 8% annually total return. In 10 years, that $1,000 becomes roughly $2,159. That's the power of compounding plus income. Compare that to a speculative tech stock with no dividend and volatile earnings. One earnings miss, and you're down 25%. Now, here's the bridge. Dividends are powerful, cash flow is critical, but energy doesn't just stop at oil, because underneath the energy transition, there's a metal nobody's talking about. Pillar 2, copper and critical minerals, the infrastructure. Backbone, B-roll, copper mines, electric grid construction. If energy is king, copper is the kingdom's bloodstream. You cannot electrify the world without copper. Electric vehicles, data centers, transmission lines, renewable grids, all of it requires copper. Supply is constrained. Mining projects take 7 to 10 years to come online. Meanwhile, demand projections are surging into 2030. This creates a structural imbalance. From an asset allocation perspective, commodities provide non-correlated exposure. they don't always move in sync with tech stocks. If you allocate $1,000 into a diversified copper mining ETF and the sector experiences a 12% annualized return over 7 years, driven by supply shortages and infrastructure build-out, that $1,000 grows to about $2,210. But here's the catch. Commodities are volatile, which brings us to something the average investor ignores in bull markets: stability. Pillar 3. Short-term treasury bills, the silent weapon show. Graphic: 6-month treasury yield at 4.5%. In 2021, holding cash was punished. In 2026, you can earn 4 to 5% risk-free on short-term US Treasury bills. That changes portfolio construction. High interest rates mean opportunity cost is real. Let's do the math. $1,000 invested in 6-month T-bills at 4.5%, rolled over annually and compounded for 10 years. That becomes roughly $1,552. No volatility, no earnings risk, no market panic. Now, will this outperform energy long term? Probably not. But here's why it matters. Treasuries provide liquidity and downside protection. They give you dry powder, and when volatility hits, and it will, you deploy capital into discounted assets. This is how the top 1% think about portfolio diversification. They don't go all in. They balance growth with stability. And speaking of growth, let's talk about tech, because it's not dying completely. It's evolving. Pillar 4, profitable tech, survival of the fittest, show chart, free cash flow, leaders in tech. Here's the truth nobody wants to hear. Speculative tech is dying. Unprofitable SaaS companies struggling. High price to sales ratios compressing. But profitable, cash flow positive tech companies with strong balance sheets, they survive. In a 4.5% rate world, valuation discipline returns. Instead of paying 30 times revenue, investors demand reasonable price-to-earnings ratios and consistent free cash flow. If you invest $1,000 into a basket of profitable tech leaders, growing earnings at 10% annually, and valuations remain stable, in 10 years, you're looking at approximately $2,593. Tech isn't dead, but easy money tech is. The rotation isn't about abandoning innovation. It's about reallocating toward quality. 3. Risk management and 2026 Outlook show chart. Market volatility index. Now let's talk risk, because rotations are never smooth. Market volatility in 2026 remains elevated. Geopolitical tensions, supply chain realignments, election cycles, and then there are black swan events. What could ruin this strategy? A sudden collapse in oil demand, a global recession that crushes industrial demand, a surprise rate cut cycle that reignites speculative tech, a geopolitical shock disrupting commodity supply chains. This is why you need a margin of safety. Never overconcentrate, avoid leverage, rebalance quarterly. The goal isn't to predict the future perfectly, it's to survive any outcome. Because investing isn't about being right once, it's about staying in the game long enough for compounding interest to work. 4. Conclusion and call to action. Let's summarize the 3 key takeaways. The 2026 market is rotating toward real-world assets. Energy and commodities are leading. Interest rates at 4.5% change asset allocation. Cash and treasuries matter again. Tech isn't dead, but only profitable, disciplined companies will thrive. This is a structural shift, not a temporary trade. If you want to see exactly how I'm structuring a 2026 diversified portfolio, including allocation percentages and risk thresholds, click the link in the description to access the 2026 Portfolio Tracker. It breaks down energy exposure, copper allocation, treasury positioning, and quality tech weighting, step by step. And now I want to hear from you. Are you still overweight tech, or are you preparing for the real asset decade? Drop your strategy in the comments, because the biggest risk in 2026 is pretending it's still 2021.